I'm going to show you exactly how I generated $117,000 in 4 months using the VIX and Bollinger Bands. And by the end of this video, you'll be able to implement this for yourself. Now, let's go ahead and look at the proof first. This is just one of my accounts that I show here on YouTube. As you can see, from September 1st all the way to the end of December of last year, okay, 4 months, I generated $117,000, as you can see, net gain right here with a 93% win-loss ratio. I'm usually winning 90% of my trades, and I keep losses extremely small with my particular strategy. Now, before we jump into it, this is not financial advice. This is just me sharing exactly how I've built wealth utilizing options. And also, if you get value out of this video, make sure to hit the thumbs up. And if you want to work closer with me, my mentorship is down below in the link. I have a live trading Discord community plus one-on-one mentorship with me. Also, I do give away free trades here on my Instagram, so make sure to be following me there. Or you could go to my free newsletter down below as well. Now, let's go ahead and jump into the exact strategy, okay? How I safely made $117,000 in 4 months utilizing the VIX and Bollinger Bands. Don't worry if you don't know what those indicators are. These are just the two most important indicators that I use, and I'm gonna dive deep into each one of them. Now, the key principles, okay? Number one is strategy selection. We're gonna dive into the exact strategy I use, the exact instruments that I use on the stocks. Then we're gonna dive into Bollinger Bands. Then we're gonna dive into VIX, and then we will go ahead and set up a trade, okay? So first off is strategy selection. I need you to understand how I trade stocks, okay? And I trade stocks utilizing options, primarily selling options, but there is a different strategy that I'm going to go to in the next slide that consists of buying options, because I know there's a lot of people out there that like to buy options, okay? So we're gonna go into two strategies. Now, the first one is the cash secured put. This is the safest strategy. This is my safe profit strategy. This is what I use for 90% of my portfolio, okay? Now let's go over what a cash secured put is, how it works, and how you could start implementing this in your portfolio. Now, how it works is, let's just say the stock is trading at $60, okay? What I will go and do is I will sell a $50 cash secured put at the 50 strike, right? And I will collect $500 for selling that option. Someone is paying me $500 to buy the option from me, right? I'm selling this 50 strike put because let's just say there's a 85% chance that this put will not be in the money, or meaning the stock will not go below 50, okay? And there is a way to calculate that in the options chain, and I'll show you exactly how to do that, okay? And that's how I'm getting a 90% win rate every single time, because the options I sell 90% of the time are not going to be in the money, meaning the stock is not going to go down there. So as long as the stock, as long as by expiration of that option, the stock is trading somewhere above $50, anywhere right here. It could go down all the way to 50.50 cents, or it could, go to 65. Either way, I'm getting my 500 bucks. All right. Now, what happens if the stock goes below 50? That is the question. Well, if it goes below 50, what happens is I still get the 500 bucks, so I still get to collect income, but I am forced to buy 100 shares at $50. That's why it's called a cash secured put, because I'm having collateral, right? Cash ready to buy 100 shares at 50. So I get the stock at a discount and I got paid to do it, okay? That's why this is such a safe strategy, because I'm getting paid to dollar cost average, and I could create income or wait till the stock rebounds to go ahead and sell the shares, okay? But it's a great way to do it. So when you're selling your first cash secured put, always ask yourself, do I want to own this stock, and do I want to own this stock at this price? Like for this example, right? Do I want to own the stock at 50? Is it a stock that I like, right? Now, if you don't have enough money to buy 100 shares, because that's, sometimes, people don't have enough money to buy 100 shares. That's totally fine. There's a way around that, and that's called a vertical spread. That's for a different video that's on my channel, okay? You could go watch that channel. But the cash secured put is, for people that could buy 100 shares. Now, the next strategy in the next slide, you don't need that much capital. You don't need as much, okay? So this could work for small accounts in the next slide. But what you want to do is, if you do want to own the stock there, you're fine selling this cash secured put at 50 because it's at a discount. For instance, if you're trading a retirement account, or you're holding stocks for the long term, but you want to create monthly income, this could be a way to do it, right? If the answer is yes, I would go 25 to 35 delta and sell that price 30 days out, okay? You could wait until expiration, set it and forget it, right? And that's what most people do. Or you could close it out at an early profit, which is what I tend to do because I consistently want to be generating income at all times and a lot of it. So let's go ahead and look at the options chain, and we will go ahead and build out a trade. As you can see, I have a lot on the line, 684K in this account. I have a lot of cash secured puts, so I put my money where my mouth is. But let's just go to NVIDIA, for instance. NVIDIA is a good one that I shouted out in my mentorship group to start selling cash secured puts on. So we're gonna go out, let's just go out 29 days. Usually I go out 30 days. Okay, we're gonna go out here. And what we can do is go to if we're like very bullish on the stock, we can go 30 delta or maybe even 35 delta, right? If want to be even safer, we'll go 25 delta, okay? And this is the delta. Delta is right here. And what delta means, that's your probability of profit, or your probability of the stock actually going down to that price. So at a 25 delta, the probability of by expiration, NVIDIA going all the way down to 116 or less is about 25%, okay? So it's very low probability that it's gonna go down that far, okay? And you get paid in proportion to the risk you take. So the closer you get to the stock, the more money you get paid, right? So that's why I like to go, 35 delta, and let's calculate the return on that. So if I sell the 35 delta, that's 560 bucks I get to collect, or $5.60 times 100, because you're controlling 100 shares, right? That's the 122 strike. So let's do that. 560 divided by 122. That's about a 4.6% return if we round up, 4.6%, okay? Annualized, and that's without compounding monthly, that's just multiplying it by 12. It's a 55% return on your capital. That's how I'm getting such high returns every year. That's how I'm doing about 45% year over year for the past 4 years straight, even through bear markets, because I'm doing this strategy, okay? So 55%, that's pretty good. Now, what if we wanted to be safe and sell the 25 delta? That's 350 bucks. Okay, we're gonna collect there, right? Divided by 116, which is the strike price. It's about a 3% return. Still very good if you analyze that. That's about 36% return. So you're getting a 3 times the market return on your money, okay? So that is how to do the cash secured put. A little bit more advanced, right? Not as easy as just buying a call option, which we're actually gonna talk about next, okay? So this is the safe profit strategy. This is how I do it because I just wanna collect income every month. I don't wanna be stressed, right? I want trading to add to my life, not take away from my life. And this is the strategy that has allowed me to do that, okay? And same with many of my clients. So let's talk about Leaps options, Leaps call options. So you probably heard about call options, right? Buying a call. Well, Leaps call options, which is a long equity anticipation security, meaning the call option the expiration date is 365 days or more, right? This is what I like to do if I'm going to buy a call option, because sometimes stocks take a long time to go up. Sometimes the stock will trade sideways for 6 months, and if you bought a 6-month call option, now you lost all your money, okay? Especially if it didn't go up and you needed it to go up. That's why I go out a year or more on my call option. So this is gonna be a strategy for massive profit. Now, I only implement the Leaps call option at a very specific moment with the VIX and with Bollinger Bands, okay? And that's gonna be later in this video. I'm gonna show you exactly when I execute Leaps call options so that I know I'm going to win 100% of the time. I've never lost on a Leaps call option because I only implement them at opportune moments. So this is a defined risk trade. How it works is basically you're gonna pay, like for this example, let's just say the stock is trading at 100. You buy the 100 strike call option, right? It costs you 2,000 bucks. So your break even by expiration in a year is 120. The stock needs to be at 120 for you to break even. What happens is once the stock starts crossing that 120 area or starts going up, right? You're gonna be making a lot of money, unlimited, literally an infinite amount of money as long as the stock keeps going up, okay? So the downside is you could lose all of the premium you paid for that option. And every day that goes by, there's theta decay, right? A typical theta decay, meaning the premium that decays out of that option because you purchased it, is usually somewhere between $6 and $15 per day, okay? Now, when you go far out, like 365 days, that theta decay is much smaller. It could be $1 per day or even less, okay? That's why I go out super far in time. I typically buy Leaps call options that are 70 delta. Time doesn't work in your favor, so you need more time to be right. And I'm trying to make, it depends. Sometimes I close out at 20% profit. Sometimes I close out at 200% profit. It really depends how far the stock goes up. Now, what's cool about it is you're getting a 2 to 3x multiple on your capital for controlling 100 shares. Let me explain what I mean by that. So we'll go to the same stock. We'll go to NVIDIA and we'll go out, let's just say 400 days, okay? March 20, 2026. So that's in a long time, 400 days, right? I'll go to the 70 delta, which is the 115, okay? So if I buy the 115 call option that expires in 400 days, that's gonna cost me $3,550, okay? Now, if I wanted to buy 100 shares and control 100 shares by buying it, that would have cost me $12,800. So you're literally controlling 100 shares for about a quarter of the capital, right? 25% of the capital required. If you wanted to buy 100 shares, that would cost you $12,000. So this is gonna cost you $3,500. You get to control 100 shares, and when the stock goes up, you're gonna be making as if you were controlling 100 shares. So the return on capital is gonna be 2 to 3 times more. It's gonna be significant. This is a leveraged product, right? So, and we could check the theta decay. The theta decay on the 115 is about, it says 3 cents, right? Which is, if you times that by 100, it's about $3, okay? $3 per day. You're losing value $3 per day. If the stock is just trading sideways, okay? You need the stock to go up. So that is the Leaps call option, all right? So that's only for massive profits if you wanna make massive profits, but you have to be more careful and you have to implement them at specific points of the Bollinger Bands and the VIX. And I'm gonna show you how we're gonna do this. So the Bollinger Bands, this is my favorite indicator. It's a statistical indicator for all the nerds out there like me. I love statistics and I love knowing what are my probabilities of being right? I want to be the casino. I want to be the house, not the person that comes in and loses all their money, right? Casinos always win because they have the statistical edge. And how we gain statistical edge is by using Bollinger Bands to our advantage, right? So what this Bollinger Bands mean, okay? Basically these bands, the upper band and the lower band, I know there's a middle band here, but we're gonna be looking at the upper and lower. Those are 2 standard deviations away from the mean price or the average price. And what that means in simple terms is that the stock is going to trade within these bands 95% of the time, okay? So 5% of the time, they will cross the band, but they tend to revert back to the average price and go back inside the bands, okay? So we're gonna use that to our advantage. This indicator gives us a good indication of the likelihood of reversal or reversion to the mean or reversion to the average price, okay? So when it hits the lower band, there tends to be a reversal back to the middle. When it crosses the upper band, there tends to be a reversal back to the middle, okay? So just because the Bollinger Band the stock touched the lower Bollinger Band or upper Bollinger Band doesn't mean that every strategy will work, okay? Usually the cash secured put will always work in that situation most of the time, right? Like 90% of the time. But the Leaps, you have to be very careful, right? So you must select one according to the VIX as well, meaning if you're gonna implement the Leaps, you have to look at the VIX, and we're gonna get into that in just a moment. I first wanna show you Palantir and how the Bollinger Bands look, okay? If we look at the Bollinger Bands, this is Palantir, one of my favorite companies to trade. Every time this stock crosses the lower Bollinger Band or touches it, it always rebounds. It always rebounds. It's done this every single time. It did it back in August. It did it back in September 2024. It did it back here in November 2024. It did it back here in January of 2025, right? So it's done it every time. And that's kind of an opportune moment on Palantir with the Bollinger Bands, okay? And then, when it does rebound, it, sometimes crosses the upper band and then it, trades within the bands, okay? So that's how that works. Now, let's talk about the VIX, okay? The VIX is the next most important thing. Now, this is basically the fear index, okay? This shows you how much fear is in the S&P 500 or the overall market. When this thing is below 15, there's not that much fear, right? There's a lot of greed. When this thing's between 15 and 20, there's a little bit of fear. So you want to take advantage of that. When it's above 20, there's a lot of fear, right? And when it's above 30, that's when you bet your house, right? That's when you go all in. And I'll show you what I mean by that, okay? So this is exactly why, like, for instance, on NVIDIA, right here in August, it crossed the lower Bollinger Band, right? Oh, what a great time to sell cash secured puts and buy leaps for massive profits, right? But not every time, okay? If we look back here, right? This was August 5th, broke the lower Bollinger Band, massive 20% discount on NVIDIA, and it rebounded really quick. And the reason it did that is because the VIX spiked, okay? The VIX spiked all the way to 67. So this was a once in a lifetime opportunity. These don't happen very often. So that was an indicator that, hey, VIX is above 25, above 30, really. We can buy some leaps here. We could also sell some cash secured puts, but buy some leaps for massive profit. Now, if you were to apply that same strategy back in January 27th and 28th, right? NVIDIA had bad earnings. The market the stock just fell 20%, right? Was it a time to buy the leaps? We crossed the lower Bollinger Band. You could have sold some cash secured puts. That would have worked out well. But if you bought leaps, that wouldn't have been good because, all right, you would have had, like, let's just check the VIX, right? Let's check the VIX. Jan 27th, the VIX was at like 17. So there was not that much fear in the market, a little bit of fear. But fear could go much higher, right? And if fear goes much higher in the overall market, then NVIDIA is going to tank even more, okay? So you don't want to be buying leaps when there's not that much fear in the market, but there's a lot of fear in NVIDIA. That's not a perfect time to buy leaps because you would have had to wait, right? Like, for instance, maybe you bought it right here. NVIDIA is not much higher and it's already been a week and a half. It's kind of trading sideways. So now you're stuck in these leaps. You're not generating income. And it really didn't bounce back like you thought it would, like it did right here, which was straight away. Within a week, we were already back towards all-time highs, okay? So that's how I look at it. With leaps, you have to place your trades when the VIX is high, like over here and over here and over here, and when NVIDIA is breaking that lower Bollinger Band or whatever stock you're trading, okay? And I use the VIX, like these are my capital allocations, like how much capital I actually deploy. VIX 10 to 12, 20% allocated. VIX 12 to 15, I'm 60% allocated. 15 to 20, I'm 80% allocated. When VIX is above 20, all my money is in the markets, in stocks and ETFs. And then when VIX is above 30, I'm allocating new cash, okay? Getting cash out of savings and checkings and putting them into my trading account. So that's exactly how I was able to take advantage of it. The stocks I was trading was NVIDIA, Palantir, Amazon, Google, and there's many videos on my channel, but these are all the positions that I was making money from, collecting income from cash secured puts and also buying leaps at opportune moments, primarily on NVIDIA, Palantir, and QQQ. So I hope you got value out of this. I have another strategy right here. This is the wheel strategy, and this is exactly how I'm generating like 10K a month, literally on Palantir alone right here. You can check that out. Super safe strategy. That one's more of a retirement strategy for income. Check it out, and I'll see you in the next one. Take care.